Kia ora everyone, welcome back to our next edition of Econ Talks. I'm here with Infometrics Chief Forecaster Gareth Kernan. Gareth, we saw the latest inflation numbers out recently. Again, an improvement. We've come down from that peak of 7.3% back in 2022. We're still seeing a lot of prices going up. I mean, how good are the latest numbers? Are we there yet?
Well, 4.7% headline inflation is obviously still well outside the Reserve Bank's target band of 1 to 3%. So it would be premature to say we're there yet. We've conquered the beast, as it were. Look, it was a result that was in line with market expectations, below the Reserve Bank's pick made back in November, to be fair, of 5%. So good in that regard. And there were some positive signs in there. I mean, we've seen a weaker global economy, for example, coming through, and tradable inflation in particular continuing to ease. We saw it in the September quarter. It's eased further in the December quarter, and now it's running at 3%. The issue with tradable inflation, of course, is there's not anything the Reserve Bank can particularly do about that, short of the exchange rate changing, and even that's not really in their direct control. The concerning thing I think among the numbers, they're good, but non-tradable inflation is still running at 5.9% per annum. And so that is above the headline rate. It has eased back. It was running at over 6.5%. But it is still elevated, both compared to headline and tradable inflation, but also compared to what we're normally used to seeing in non-tradable inflation. If you look back over the last 20 odd years, non-tradable inflation typically sits at somewhere around about 3 to maybe 3.5% per annum. So the latest quarterly figure was a 1.1% increase. So you take that over the course of the year, we're still running at somewhere around about 4.5% there. So there's still signs that those sort of lingering cost pressures in the domestic economy are hanging around, and probably not too surprising when you consider that one of the bigger components that feeds through, particularly into non-tradable inflation, is just around labour costs. And it's only more recently that the labour market has started to show signs of easing, and we haven't really seen it coming through in terms of wage costs and labour costs yet. So we'll be looking for that closely through the course of the rest of this year, expecting it to continue moderating, but the Reserve Bank will have a keen eye on it as well.
Absolutely. And I mean, I think it was interesting looking through those numbers. You mentioned it was close to market pick. I mean, how good does that feel as a forecaster, right? That we're getting a bit closer to it. There was a time when everyone was forecasting and, inflation was always far and away seemingly above what we were picking in a very uncomfortable fashion. So now that we are, I think, getting a bit of a better handle on where those inflationary pressures are going, that is encouraging. I mean, it's interesting, I think, to look through some of those components of inflation. You are seeing some areas where there is certainly less intense pressure, where interest rate increases are working to dampen back demand, and that's meaning that there's less ability to continue to put prices up even further. We saw in the latest data for December, the percentage of items that are being discounted hit the highest it's been, I think, in something like 6 years. You saw the largest number of items that are tracked by Stats NZ actually fall in price in about 3 years, and back towards more normal sort of pre-pandemic levels, when you've always got some things going up and some things going down. It's just previously almost everything's been going up and sort of nothing has been moderating on the other side. So that's encouraging. Still some catch up, I think, coming through as well in terms of the interest rate sensitive areas, the likes of furniture and housing, furnishings and contents are going down. Some stuff like insurance costs, though, also the likes of cigarette tax and rates and what have you, they've taken a bit of time to filter through into the system. But I think we're still worried about some parts of those price increases, particularly rents. Rents running at 4.5% per annum. Apart from one quarter back, I think in 2022, the rental increase is like the fastest we've seen in modern history. So you are seeing that additional demand from net migration spiking to above 130,000 per annum. Those sort of pressures are, I think, going to be increasingly difficult. I mean, the pathway here, Gareth, does seem to be that inflation will continue to moderate. The likes of shipping issues that are coming through from the Red Sea, seeing the likes of shipping costs spike up to 2-3 times what they were before. That's uncomfortable. Probably not enough to say that inflation's going to spike away worse, but maybe moderates how quickly we get it under control. I mean, how far away are we, just very briefly, from getting it back into the box? The Reserve Bank's, of course, targeting between 1 and 3%. How difficult is it going to be getting that last sort of couple of percentage points down?
Yeah, look, our expectation is that we get inflation back under 3% now in the second half of this year, and that's in line with what the Reserve Bank had been talking about. We thought they were a bit ambitious previously, but those inflation trends and underlying pressures do seem to have moved in their favour in general. So previously, look, it was a case of, I think, forecasting inflation and going, well, it might come down, but it's hard to see it turning around quickly. Now we are definitely seeing that downward trend coming through in the numbers. And like you say, there's just a few sort of, I guess, upside risks, if I can call them that, which won't necessarily spike inflation higher, but could just prevent it coming down quite as quickly. The likes of that Red Sea conflict and the effect it has on shipping costs, the likes of net migration and just how much it continues to flow through into rents in particular, other sort of housing related pressures that flow through into possible cost increases. I'm not so concerned about some of the sort of more retail effects of more people in the country because, look, retailers have been under a lot of pressure anyway. And as you say, there's probably more discounting going on than there has been for some time. But yeah, there's risks there that may just prevent the moderation, but overall does look on track to be below 3% before the end of this year. It could be that last sort of 0.5 to 1%, getting it back to the midpoint of 2% is the really difficult part to squeeze out and does rely on that domestic inflation and pricing pressure being pulled back further. And so that's probably the bit when you look out to 25 and 26 where the Reserve Bank won't want to be easing monetary policy too quickly to make sure that they get that final bit out of the system.
Definitely. And I think, I mean, that's the thing, right? The numbers that we're getting through on inflation, definitely a better outcome. We're definitely on the right pathway to bring inflation under control. It's a lot better than where it had been at the peak, but we're also not done with that inflation battle yet. There's still work to be done, and we're still going to have to sort of wait a bit of time for those moderations to fully come in. We'll continue to assess where the likes of inflation goes and what that means for other parts of the economy, including where interest rates move next on one of our future editions of Econ Talks.